Hello everyone, and welcome to Business Hub. The idea that investing is just for the wealthy is the largest misperception about it. In the past, that might have been accurate, but thanks to businesses and services that have made it their mission to make investment possibilities accessible to everyone, including beginners and those who have only a modest amount of money to invest, that entry hurdle has been removed. There is actually no need to skip out given that there are so many investments available to beginners. The good news is that investing is a terrific method to increase your money, so this is great news. We have chosen to emphasize key personal attitudes and overarching strategic frameworks that, in our opinion, will help you to become an intelligent investor. Before starting, don't forget to like and subscribe to our channel for more future updates. So let's start. Number 1. Have a financial plan. Creating a financial plan with goals and milestones should be the first step in becoming a successful investor. These objectives and benchmarks might include deadlines for saving certain sums of money. The objectives in question might be, for instance, having sufficient funds to enable home ownership, supporting your children's education, creating an emergency fund, having sufficient to fund an entrepreneurial enterprise, or having the resources to enable a pleasant retirement. Additionally, while the majority of individuals focus on saving for retirement, achieving financial independence as soon as feasible would be a goal that is even more desired. Financial independence, retire early, is an initiative with this objective as its focus. Number 2, make saving a priority. You need to have money to invest before you can start investing. For the majority of people, that means saving a portion of each paycheck. An appealing option to make saving automatic is to sign up for your company's savings program, such as a 401k, especially if your employer would match all or a portion of your personal contributions. In addition to using employer-sponsored plans, you may take into account additional options while putting up your financial plan for automatic saving. Aggressive saving is often the cornerstone of wealth creation, followed by wise investing intended to increase those savings. Number 3, understand the power of compounding. You may fully benefit from the power of compounding to enhance your wealth if you save and invest on a regular, systematic basis, and begin this discipline as early in life as possible. The current extended period of historically low interest rates has somewhat reduced the power of compounding, but it has also increased the importance of starting early to accumulate savings and wealth because, other things being equal, it will take interest-bearing and dividend-paying investments longer to double in value. Number 4, understand risk. Default risk on bonds and stock volatility, which can result in large, rapid gains or reductions in value, are just 2 examples of the numerous facets of investment risk. A trade-off between risk and reward or between risk and return is also generally present. Consequently, taking on more risk, including the possibility of losing all or a portion of your investment, is frequently required to get larger returns on your investments. You should ascertain your individual risk tolerance as a crucial step in the planning process. What kinds of investments are best for you will depend on a number of factors, including your ability to lose money in the event that a potential investment loses value, and how much price fluctuation you can tolerate without becoming overly anxious. Number 5, understand diversification and asset allocation. Asset allocation and diversification are 2 ideas that are closely tied to one another and are crucial for minimizing investment risk and maximizing investment returns. In general, diversification is distributing your investment portfolio among a variety of securities in the hopes that below-average returns or losses in some securities will be offset by above-average returns or profits in other securities. Similar objectives are pursued through asset allocation, but the emphasis is on spreading your portfolio among the main investment types, such as stocks, bonds, and cash. Again, as part of your ongoing financial planning process, you should frequently review your choices regarding asset allocation and diversification. Number 6, keep costs low. Although you have no control over future investment returns, you do have control over costs. Additionally, expenses like transaction fees, account fees, management fees for investments, etc. can have a big impact on how well investments perform. Similarly, high cost does not always equate to superior performance, to use mutual funds as just one example. Number 7, understand classic investment strategies. Active versus passive investing, value versus growth investing, and income-oriented versus gains-oriented investing are among the investment techniques that new investors should completely comprehend. Although some astute investment managers are capable of outperforming the market, few do so consistently over the long run. This prompts some financial experts to advocate low-cost passive investing techniques, particularly those that make use of index funds that aim to replicate the market. Value investors choose equity investments that look to be reasonably priced compared to the market on metrics like price-earnings ratios because they believe that these investments will have both low downside risk and possible upside. Growth investors, on the other hand, even though they are more pricey, see more potential for profit in stocks that are registering quick gains in revenues and earnings. Income-oriented investors look for a consistent stream of dividends and interest payments, either because they require the continued access to income or because they believe doing so will help them manage their investment risk, or a combination of the two. Focusing on equities that promise dividend growth is one of the many forms of income-oriented investing. Gains-oriented investors are primarily preoccupied with the income generated by their investments and instead search for those that appear likely to produce the greatest price increase over the long run. Number 8. Be disciplined. Stay disciplined if you are investing for the long run in accordance with a well-thought-out and well-built financial plan. Aim not to get thrilled or shaken by brief market movements and potentially sensationalistic media coverage of the markets that may cause panic. Take market experts' predictions with a grain of salt unless they have a long track record of accurate forecasting that has been objectively validated. Few do. Number 9. Think like an owner or lender. Stocks are fractional interests in a company. Bonds are loans given to the issuer by investors. Think like a potential business owner before you purchase a stock, or like a potential lender before you buy a bond, if you want to be a wise long-term investor rather than a short-term speculator. Do you want to be a creditor of that issuer or a shareholder in that company? Number 10. If you don't understand it, don't invest in it. Beginning investors today face a vast array of investment options that they may not fully understand due to the proliferation of complex and novel investment products, as well as businesses with complex and novel business models. Never make an investment that you do not fully understand, especially in terms of its risks, is a straightforward and wise rule of thumb. The implication is to exercise extreme caution when avoiding investing fads, as many of them might not endure over time. This is it for today's video. What do you think of our video? Feel free to share your thoughts in the comment section below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.